When we think of Warren Buffett today, we think of the Oracle of Omaha, the man with a $150 billion cash pile and a portfolio of global icons like Apple, Coca-Cola, and American Express. But the Warren Buffett of 1965 was someone very different. He was a 35-year-old value investor, a student of the legendary Benjamin Graham, who had just made what he would later call his biggest mistake. He had just taken control of Berkshire Hathaway. At the time, Berkshire wasn't a world-conquering conglomerate, it was a struggling, cigar but textile company in New Bedford, Massachusetts. On the day he took control in April 1965, a single share changed hands for just $18. Most investors skip the first 10 years of the Berkshire letters. They want the 1980s and 90s when the billions were rolling in and the wisdom was polished. But the first decade, 1965 to 1975, is where the real secrets are hidden. This is the decade where Buffett transformed a dying mill into the world's greatest compounding machine. Think about the context of this era. This decade saw the Vietnam War, the rise and fall of the Nifty 50 stocks, massive inflation, and the brutal 1974 bear market. Through it all, Buffett wasn't just picking stocks, he was engineering a new kind of corporate structure. If you had invested $10,000 with Buffett in 1965, by the end of 1975, you wouldn't just be wealthier, you would have witnessed a masterclass in capital allocation. Today, we are going back to the source. We're analyzing the Genesis years. We'll look at the math of the textile failure, the genius of the insurance float, the discipline of his banking acquisitions, and why a 50% stock market crash in 1974 was actually the best thing that ever happened to Berkshire Hathaway. Put on your glasses. We're going deep into the archives. In the 1965 letter, the numbers looked deceptively good. Net earnings were $2.2 million, a massive jump from just $125,586 the year before. Buffett was doing exactly what he was trained to do, lean out the business. He closed unprofitable plants, like the King Philip plants in Fall River, and concentrated production. But here is the insight that Buffett realized almost immediately. The textile business was a brutal, commodity-driven industry. In his 1966 letter, he started being brutally honest with shareholders. He noted that heavy imports, plus a change in styling trends, were depressing prices. The capital expenditure death spiral. In a commodity business like textiles, you have no pricing power. If your competitor buys a new machine that makes cloth 10% cheaper, you have to buy that same machine just to survive. But when everyone buys the machine, the price of cloth just drops by 10%. The customer wins, the machine manufacturer wins, but the business owner gets a 0% return on that new investment. Buffett realized he was in a commodity trap. No matter how hard he worked or how much he improved efficiency, he was rowing against a current of global competition and declining demand. Instead of reinvesting all the textile profits back into the mills, which is what most traditional CEOs would have done, Buffett did something radical. He started using that cash to buy back shares and diversify. Between 1961 and 1966, Berkshire reduced its outstanding shares by 37%. By shrinking the denominator, he increased the book value per share from $23.37 to $28.99, even though the underlying business was struggling. Lesson number 1 from the archives: know when your business is a dog. Buffett saw that textiles would never provide a high return on capital. He decided to treat Berkshire not as a textile company, but as a capital allocation vehicle. In 1966, he explicitly told shareholders he was looking for acquisitions outside the textile field. He was looking for a better engine. In 1967, Buffett made the most important move in Berkshire's history. He bought National Indemnity Company and National Fire and Marine Insurance for $8.6 million. To the average investor, insurance is boring. To Buffett, insurance is the ultimate financial hack because of a concept called float. Let's break down the math of float, because if you understand this, you understand Berkshire. When you pay your car insurance premium, the company gets your money today. However, the company might not have to pay out a claim on that policy for months or even years. In the meantime, the company gets to invest that money and keep 100% of the investment profits. In the 1968 letter, Buffett pointed out that National Indemnity was producing a good underwriting profit, while the rest of the insurance industry was losing money. This was the double win. First, underwriting profit. They collected more in premiums than they paid out in claims. This meant the float was essentially a loan with a negative interest rate. People were paying Buffett to hold their money. Second, investment profit. Buffett took that free money and bought high-quality stocks and other businesses. By 1970, the insurance subsidiaries were already contributing more to the bottom line than the textile business. Buffett had found his engine. He wasn't just a textile guy anymore. He was an insurance mogul with a growing pool of free capital that he could deploy wherever he saw the highest returns. In 1973, he doubled down, borrowing $20 million at 8% interest, a massive amount for Berkshire at the time, specifically to pump more capital into the insurance business. Why borrow at 8%? Because he knew he could invest that capital and the resulting float to earn 15% or 20% over the long term. This was the birth of the supercat strategy we see today. While everyone focuses on insurance, the Genesis years featured another powerhouse that most people forget, the Illinois National Bank and Trust Company of Rockford, acquired in 1969. If you want to see what Buffett considers a perfect business, read the 1971 letter. Illinois National Bank was a masterpiece of efficiency. While the average bank was lucky to earn 0.5% or 1% on its assets, Illinois National was earning well over 2% after tax on average deposits. How did they do it? It wasn't through risky lending. In fact, it was the opposite. Buffett noted that the bank had almost no borrowed funds, liquidity far above the industry average, loan losses far below the industry average. The secret sauce was management discipline. The bank was run by Gene Abegg, a man Buffett described as having superb skills. Abegg didn't care about having the fanciest building or the most employees. He cared about the spread, the difference between what he paid for deposits and what he earned on loans. This taught Buffett a core principle that still defines Berkshire today. Find a business that is the best in its geography or niche, run by people who love the business more than the money. However, the Bank Holding Company Act of 1969 eventually forced Berkshire to either sell the bank or diversify even further. This regulatory hurdle is actually what pushed Buffett to accelerate his acquisitions of other non-banking businesses. He turned a regulatory problem into an opportunity to expand his empire. By 1973, despite rising interest rates, the bank was still maintaining that 2.1% return. It was a cash cow that funded his stock market purchases during the coming storm. If you want to test your mettle as an investor, you have to look at 1974. This was one of the most brutal bear markets in history. Inflation was skyrocketing, the oil crisis was in full swing, and investors were fleeing the market in terror. The S&P 500 dropped 26.4% in 1974. But Berkshire's market price? It got absolutely slaughtered, dropping 48.7%. Think about that. If you had bought Berkshire for $18 in 1965 and watched it grow to around $90 by 1973, you suddenly saw your investment crash back down into $40. Most people would have sold. Most people would have said, Buffett's luck has run out. But look at what Buffett wrote in the 1974 letter. This is where the mindset separates the winners from the losers. While the market price fell 48%, the per-share book value actually grew by 5.5%. Buffett used this letter to teach one of his most famous lessons. Price is what you pay, value is what you get. The businesses, the bank, the insurance companies, See's Candies, were still making money. They were still growing. The market was just having a massive, irrational temper tantrum. In 1974, Buffett wasn't panicked. He was a kid in a candy store. He famously told Forbes magazine during this period, "I feel like an oversexed guy in a harem." He used the crash to load up on what would become legendary positions. He bought a massive stake in the Washington Post when it was trading for a fraction of its liquidation value. He bought into Geico when it was on the brink of bankruptcy, seeing the underlying strength of its direct-to-consumer model. By the end of 1975, the market realized its mistake. Berkshire's book value roared back with a 21.9% gain. He had used the panic in the streets to buy the assets that would make him a billionaire 10 times over. Before we wrap up this decade, we have to take a deep dive that most people ignore: the 1975 supplement on pensions. Even in the mid-70s, Buffett was looking at the long-term structural risks of the American economy. He saw that many companies were promising pension benefits to their employees that they couldn't possibly afford. He called these unfunded liabilities a ticking time bomb. He decided that Berkshire should gain at least partial command over fund investments to ensure they weren't caught in a future crisis. He was thinking about the solvency of his companies 30 years into the future while other CEOs were just thinking about the next quarter. The inflation tax. He also began his long crusade against inflation. In the 1975 letter, he noted that a repeat of our overall operating performance in 1976 would produce much smaller net earnings because the tax cushion from previous textile losses was finally exhausted. But more importantly, he explained how inflation is a hidden tax on capital. If a business earns 15% on equity, but inflation is 10%, the real return is only 5%. And then the government taxes you on the full 15%. Buffett was teaching his shareholders to look past nominal dollars and focus on real purchasing power. This is why he eventually shifted his strategy from cheap companies to quality companies with pricing power. If a company can raise prices to match inflation without losing customers, like See's Candies, it is the ultimate inflation hedge. This realization, which crystallized in the mid-70s, is what paved the way for his multi-billion-dollar bet on Coca-Cola a decade later. By the end of 1975, the genesis of Berkshire Hathaway was complete. In just 10 years, Buffett had executed a perfect structural transformation. The textile business was no longer the master. It was a small, shrinking segment that provided the initial seed capital. The insurance engine was humming, providing a growing, permanent stream of low-cost float. The bank was providing rock-solid, high-yield cash flow with zero drama. The portfolio was packed with high-quality companies like the Washington Post, bought at absurd prices during the 1974 crash. From 1965 to 2016, Berkshire compounded at 20.8% per year. That is the difference between an $18 share and a $244,000 share. That is how you turn $10,000 into $135 million. The lesson for us? Don't look for the hot stock of the week or the latest meme trend. Look for the engine. Find a way to create your own float, whether that's through a high-margin business, a disciplined savings rate, or a side hustle that provides low-cost capital for your investments. And remember, when the market crashes by 50%, like it did for Buffett in 1974, that isn't a disaster. It is a gift. If your book value, your actual earning power, and your knowledge is still growing, the market price is just noise. Thanks for joining me on this deep dive into the Buffett Archives. This was just the first decade. If you want more analysis of the 1980s letters, the era where he buys Geico and Coca-Cola and becomes a household name, hit the subscribe button and let me know in the comments.